Monetary policy, the Federal Reserve Bank is going to have tools that they can use. So in fiscal policy, we had government spending and we had taxes. Those are our fiscal policy that affect aggregate demand. Now, when it comes to monetary policy, you got to remember this is the central bank or the Federal Reserve. It has two names, of course, just like everything does. Okay, same thing again. We have recession, we have inflation, then there are policies and tools to fix it. So the Federal Reserve Bank can have expansionary and contractionary, just like everything else. Okay. Now, in the multiple deposit expansion video, you learn about reserve ratio. So the reserve ratio is going to be the percentage of the deposits they have to keep in the bank. Now, if we want to change those things, the Federal Reserve Bank has reserve ratio, they have the discount rate, and they have the Fed funds rate. Okay. They also have open market operations. So open market operations are going to be bonds. Now, if they want to make the money supply larger in order to lower the interest rate, they would buy bonds. So buy bonds equals big bucks. Okay? So buying bonds is going to make big bucks. What I mean by that is we have our money supply. And this graph illustrates a vertical money supply, which indicates the Federal Reserve Bank is in control of it. In lowercase I is the nominal interest rate. So we have a certain quantity of money that's available, and then wherever that money supply crosses money demand, we're going to get it in equilibrium or a price. Remember, everything's a supply and demand graph, just with different labels. So the lowercase I is our nominal interest rate. So the money supply meets money demand, and there's two types. You have transaction and asset demand. Okay, so transaction or asset, that means simply what people are going to need money for. So if we want to buy bonds, make big bucks, that makes this money supply increase. Okay, so if the money supply increases, it's going to shift to the right, MS1, Q to Q1, and then where I have a new equilibrium, I have a lower interest rate. So buying bonds makes big bucks, makes the money supply increase, therefore the nominal interest rate will drop. When that happens, at low interest, remember, people borrow money, so investment will increase. So consumption and investment will go up, and that leads to aggregate demand going up, and GDP going up, unemployment going down, and inflation going up. So monetary policy can have the same kind of effect on aggregate demand, but it's targeting this interest rate right here. Now, the other way the interest rate can be affected is by messing with the discount rate and the Fed funds rate. The discount rate is Fed to bank. So if a bank runs out of money and they need some money to cover overnight loans or things like that, deposits, then they can call the Federal Reserve Bank, and this is the interest rate in which the Federal Reserve Bank would lend a bank money. Okay, the Fed funds rate is bank to bank. Now the Fed funds rate is, say your bank runs out of money and can't cover the deposits, then they call another bank, and that bank would lend them money at a set interest rate. So that way they can't price gouge each other. So these two are to target interest rates, because we don't want anyone to be able to set prices on anything in the economy. That would be bad. We want a free market economy. So this just creates a floor. So if a bank borrows at 5% from the federal fund on the federal funds rate, then that means that they can charge 6% and make money and whatnot. So if they want to lower these, those would be expansionary. If you lower the discount rate or the Fed funds rate, that would lead to the same things over here. Lower interest rate targets. Investment goes up. Okay. Now, as far as the reserve ratio goes, the reserve ratio is the percentage that the bank must keep of your deposits. So if the reserve ratio is lowered, that means the required reserves would be lowered and excess reserves would increase. Okay, so excess reserves is what they can loan out. And if banks are loaning out money, then that's going to make multiple deposit expansion happen, or fractional reserve banking that will create money. And if we create more money, then we get low interest, then we get more investment and things like that. So when we go to monetary policy, you're going to use these tools of the Fed in order to fill out this sheet.